Hello, fellow RoboCapitals. Hope you're well. Coming to you today from one of my rental properties in Medellin. My apartment has a plumbing leak, but we are here and we are ready to rock because we've got payroll, non-farm payrolls today, and they definitely beat expectations. That's for sure. But you guys know the rest of the story. What about the revisions? That's what we've got to go over, and that's really the important part for this report. So let's go straight over to, let's start with the Market Watch calendar, and let me do a quick refresh so we can see what the expectations were and what the actual number was. So here we go. Expectations were for 55,000. That was the median forecast. Last month, as a reminder, we had 48,000. Bumped all the way up to 130,000. So that's a huge beat. And by the way, the unemployment rate goes down to 4.3%. Not bad. Hourly wages, more than what we expected. So when you look at just this at surface level, it's pretty good. Now, why do I only say it's pretty good? Because still at 130,000 jobs added in an economy with 350 plus million people, that's not good. That's that's not keeping up with population growth or how many people are added to the workforce, especially because the labor force participation actually increased slightly. But it is a beat, absolutely a beat. So let's go ahead. I'd like to give you a test as Rebel Capitalist subscribers or watchers, because you've got to start thinking about these things. So if I told you we had a 130,000 number and the expectation was for 55,000, what would you expect interest rates to do? We'll just say the 10-year treasury yield. Josh, let's check out the chat and see what people are saying here. What would you guys think that are watching this video right now, or if you're watching it after the fact, you can just kind of answer in your own head. What would you say would happen to the 10-year treasury yield given the fact that non-farm payrolls were expected to be 55,000 and we got a huge beat, 130,000? So we've got go down, okay? So I think for CUCV Farmer, I would ask you, why would you think that interest rates would go down? Everyone is saying interest rates would go down. Why is it that interest rates would go down? So now you guys know from watching my channel that the long end of the curve especially is all about growth and inflation expectations. So if we go back to this calendar, we see that the expectation was 55,000, 130. So growth and inflation, let's focus on the growth part. Growth, you would assume would increase, or at least the expectations would be for growth to be higher than where we previously thought it would be on a move forward basis. So if the growth expectations increase, then the punchline here, the answer is you should expect interest rates to increase as well. So let's go over to the 10-year treasury yield and see exactly what happened. So right now, we are trading around 4.17, but I want you to notice where we were prior to the data coming out at 8:30. Right here at 8:28 a.m. Eastern time, we're at 4.128%. So we are trading right now, call it 5 basis points, roughly, higher than that. But look where we went. We went all the way up to 120, call it. So we have an increase of 7 or 8 basis points, just boom, immediately, as soon as the data came out. So this is a perfect example of what we talk about on this channel all the time. And that is the narrative on what drives yields versus reality. So the narrative is always the debt deficits, issuance, the dumping of treasuries by the Dutch Sovereign Wealth Fund, as an example. These are all things that impact interest rates. In reality, they don't impact interest rates at all. At all. The only thing that really drives interest rates, especially over the long run, and you can tell just by today's price action or the yield action, is growth and inflation expectations. Okay, cool. So now let's go over to the actual BLS report and dive into the details here, guys. So let me zoom in. The headline here is what you expect. You can see in some charts, if that helps you visualize it a little bit better. And I wish we went back further because you would see a dramatic decline in the non-farm payroll numbers. So it's all about the trend, and the trend still is lower, although this was I'm not going to call it a fantastic number. It was a fantastic number relative to expectations, that's for sure. But in and of itself, it's just, I'd say it's okay. So then we go down here to household survey. They talk about the labor force participation rate increasing. They talk about how the unemployment rate went down to 4.3. But here is where the devil is in the details. Actually, let's go down to the adjustments made here. Revisions. So I'm not going to go into how all the details because it gets really muddy and complex. I actually had to do about a half hour worth of research this morning to get my head around exactly how they do these revisions. But the main thing, the main takeaway here is and now let me actually preface with there's multiple ways that the BLS does these revisions. So the first revisions that you guys are all familiar with is when they revise just the last 2 months. Okay. So those revisions are right here. Total non-farm payroll rose by 130. We know that. I'm sorry, those are not the revisions. They downwardly revised the past 2 months. And where are those? Let's see here. Bear with me, guys. Sorry about that. Well, I know it right off the top of my head. Here we go. They downwardly revised, I found it, 15,000 for November. So it was downwardly revised by 15,000 jobs from 56,000 to 41,000. Okay. December, downwardly revised just slightly, 2,000 from 50,000 down to 48,000. So they say these revisions in total, 17,000 jobs lower than what was previously reported. So these are the revisions that most people think about when I say revisions, right? But there are other ones. They do them annually. Okay. And so now let's get into the annual revisions they do. And this is where I think the rubber meets the road. So this is where I want to keep this as simple as possible. The benchmark they use for determining how many jobs were created or lost in 2025, they revised that benchmark. Okay. So what they just did is they revised the benchmark used for 2025, which was March of 2025, that specific month. Okay. And the conclusion here, and they do this by using the QCEW, which is the Quarterly Census of Employment and Wages, which counts jobs covered by the unemployment insurance tax system. They also do these revisions based on the birth death model, which down later in the report they say was flawed. So they made, and by the way, I want to give a huge hat tip to Mike Green and I believe Danielle DiMartino Booth, my two friends that I've been talking about this nonstop, how the birth death model is completely flawed. And they actually admit that in this report. They made some changes there, which contributed to these annual revisions that we're focusing on now. So here we go. The seasonally adjusted total non-farm payroll level for that benchmark, March 2025, was revised downward by 898,000 jobs. 898,000 jobs, basically 900,000. The benchmark was downwardly revised. Now, that doesn't mean that the overall job count, it does mean that prior to March 2025, but after, if we're just trying to figure out the year of 2025, it doesn't mean that we have to downwardly revise the whole year by, let's say, 900,000 jobs, because we lower the benchmark, but then we lower each one of the preceding months. And again, I almost need a whiteboard to explain this to you. But the main thing that you need to know is that the benchmark was downwardly revised by, we'll call it 900,000. And what that means is the total amount of jobs for 2025 was previously stated at 584,000. This is where I'm reading it right here. But now, in reality, that was 881,000. So call it a total loss or downward revision, whatever you want to call it, of about 400,000 jobs. So there were 400,000 jobs fewer in 2025 than we previously thought. That's a huge number. That's a huge number. And not even considering the downward revision to the actual benchmark was almost 1 million. So it's very difficult. And by the way, actually, here's where they talk about the birth-death model. Also effective in this new release, Establishment Survey changed the birth-death model to incorporate current sample information each month. And again, want to give a huge hat tip to my good friend Mike Green and Danielle DiMartino Booth, who have been talking about this nonstop, talking about the flaws in the birth-death model. So now you go back to this 130,000 and you're like, wow, I mean, it's good, better than expected, but I mean, should I take it with a grain of salt? Because we know there's a 99% chance that it gets downwardly revised just in the next couple months. And what's the downward revision going to be next year when they do these annual benchmark changes, right? And so I think you see exactly how the market perceived this report. And you can see that in the yields. It's very interesting. So let's go back to the 10-year Treasury yield and this chart where right out the bat, you get, whoa, the economy's jamming. The economy's in fuego. The headline number is way better than we thought. Inflation expectations skyrocket, go through the roof. Growth in inflation expectations. But then look what happens. Oh, wait, the revisions to last 2 months were downwardly revised by 17,000. What happens to growth inflation expectations? Starts to go down, right? And then we get into the real details where we look at the benchmark revisions for March of 2025. And then we're like, whoa, minus 900,000. And like, okay, well, what was the total that we gained in 2025? Oh, it went from 580 down to 180. Oh, whoa. What's happening to growth and inflation expectations the whole time? It's going down just like this chart. It's going down just like this chart of yields. Now, I don't know what spiked it up here, but you see what I'm saying? You see what I'm saying? And this is exactly how I saw the report. Initially, I'm like, wow, that's great. But then you get into the details, and the more you get into the details, the more you come to the conclusion that, I don't know. I don't know if this increases my expectations for growth and inflation in the U.S. economy moving forward. Maybe it does, maybe it doesn't, but the odds are definitely way, way, way different than if you just look at the headline number. And what this goes back to, guys, is another thing we've been talking about on this channel all the time. And that's this divergence with the labor market in GDP and trying to figure out, who's right and who's wrong. So this is a mixed report. If you look at the headline number, looks pretty good. That's going to, I think, add or increase the odds the GDP numbers are correct. But then when you look at the revisions, I think we go back to it increasing the odds that the labor market or the previous data we have seen in the labor market is actually correct. And one has to assume that this 130 is going to be downwardly revised. Who knows to what degree? Now, I think Zero Hedge had a great article on this, and they go into the actual table from the BLS. But the chart that I wanted to highlight was, let's see, it was the percentage miss. So let's see. They talk about, it's something like 95% of the time, the numbers are downwardly revised. It's worth here we go. 25 of the past 26 jobs reports have been revised lower. I mean, at some point, you've got to look at your model and say, you know what, maybe my model's broken. And hopefully they're starting to do that over there. But it looks like the actual economic release values, the last price, and then U.S. non-farm payroll month over month. Okay. So the bottom line, the punchline is, if you're a bull, there's some good news in there for you. Absolutely. If you're an economic bear, forget the stock market. If you're an economic bear, there's also some things in there for you. So I'll let you decide. I'll let you decide whether this is good news for GDP or good news for the labor market, or maybe, as far as those indicators, or maybe it's just split in the middle. It's obvious what the bond market thinks, what the treasury market thinks. Why? Because you can tell with the signals that you're getting from paying attention to those yields, which we always talk about on this channel, is so incredibly important. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. We'll see you in the next video.